Hello everyone, Dividend Enjoyer here, and today I'm going to be doing a stock analysis video on Enbridge stock, ticker symbol ENB. I previously made a video on this a little while ago, so I thought it'd be interesting to kind of go over the financials again and do a DCF analysis of the stock. This is a diversified energy company according to them, and they have four core businesses, including liquids pipelines, natural gas pipelines, gas utilities and storage, and renewable energy. Obviously, the biggest things that they have are the pipelines. They move a lot of natural gas, and then they essentially collect a toll for that. But they also do the gas utilities and storage, so they'll store a bunch of natural gas in different areas, which then they can move through the pipelines. They also have renewable energy, which is its own segment. If you're interested to learn a lot more about that, you can look at their About Us page on their website if you're interested. But I thought that was interesting. I'm not going to obviously do a deep dive into every little part about it. But I think that these types of businesses in this industry is something that you could bet on long term if you believe that the need for additional energy by data centers is going to be sustained going into the future. I think that companies like Enbridge that supply natural gas or energy are going to be a good bet in the long term. These companies generally have very strong dividends. One of the main kind of issues with these stocks right now are the tariffs by Canada, because this is one of the industries that's getting hit very hard. But good performance out of Enbridge. The company is up 20.88% in the past year. Current market cap is $98.08 billion. Price to earnings ratio is 22.79, and the annual dividend yield is 6.09%. There's a 52-week low of $36.50 and a 52-week high of $47.44. So we are kind of near those 52-week highs right now, but there usually isn't that much volatility within these companies. Full disclosure, I completely sold out of Energy Transfer, which is a very similar type of business. I had made a decent amount of money, so I just wanted to cash out. If you're interested in that, you can check out my portfolio playlist, but I essentially made about, I think, $5,700 on it because I held it since 2021. And, I've always really loved businesses like Enbridge, like Energy Transfer, because the dividends are very solid. But I really think that, because I think that the fact that everyone thinks that this is going to be a sustained long-term thing and that it's going to be fine is a little bit difficult. I also think that you have some of the EVs coming in, but I do think the need for electricity in the short term is going to be much higher with these AI kind of training data centers and all the things with AI that is going to need more electrical infrastructure. So I do think that these companies are pretty strong as a sector, but I also wonder if, we're transitioning more towards electric vehicles, things like that, kind of moving away from petroleum more. It does make me worry for the long term, and I worry about missing out on potential gains from somewhere else. This is more devil's advocate. I do actually think the industry is probably reliably going to do well. I just think that a safer bet might be something like waste management or something more defensive. And I already kind of had that position for a really long time, and I feel like I made enough money on it. Sorry for the side tangent, but moving on to what analysts think of Enbridge in particular, we have 23 ratings currently, with 8 rating a buy, 11 rating a hold, and then looks like 4 rating a strong buy and maybe 1 rating an underperform. And the average analyst price target is actually right where the stock is, which is interesting. So I think a lot of analysts probably think that this is a little bit overvalued, but some of the ones that are more bullish probably see the need for energy being a lot higher than what some of the other analysts may have forecasted, the potential cost of energy in the next couple of years. I think that this industry is still good. In my opinion, is that the stock is probably going to continue to perform well. I just think that there are going to be stocks in other industries that'll perform better, and I'm really trying to chase the maximum amount of gains from this AI technology. I'm trying to get into the companies that are really going to be producing a lot more, in my opinion, and trying to avoid the really fraudulent ones, which is obviously difficult. But I like Enbridge. I think it's a very strong business. I think that if we go through the financials, it may look pricey, it may look cheap, but that's what we're going to do in the next section. So stay tuned for the DCF analysis. Here is the DCF portion of the video. Here you can see I have a weighted average cost of capital for Enbridge of 5.09%. And when we apply that as the discount rate here in our model, we can see that Enbridge would need a 3% on average growth rate of the free cash flow based on the trailing 12-month number. Enbridge would need a 3% growth rate on average of the free cash flow to be able to justify the current price. And we can see here, though, that the average revenue growth has been 7.9%. But a real downside of this industry is that a lot of it is based off of the demand and the actual value of the natural gas. So you can have weird years like 2023 where revenue was not very good. You can also have times like COVID where I think they were doing quite well because everyone was at home. Some places obviously weren't buying as much. Really, the thing you're betting on with Enbridge is the actual demand in natural gas. So it's kind of hard to actually model. But I will say, if you think that on average they're going to grow 4% a year, there's still 17% upside to the stock. I'm not recommending or saying anything about the stock because we can see with the 0% growth, if they just stay the exact same and make the exact same money, there's negative 42% upside to the stock. So there needs to be some kind of growth rate in there. 2% is not enough. 3% or above, that's where, in theory, if my model is correct, you would want to be investing into Enbridge. I think that it's probably fair that the company could grow 5% on average. I think that a lot of the companies in this sector are probably undervalued compared to what they should be valued at if they can actually get consistent growth. But I also think that there are a lot of factors outside of your control when you're investing in a company like this. And I just think that there's a lot of inherent risk here. But I think if you're someone who wants to ride out the end of kind of the Trump tariffs and everything like that, I really think that there's a lot of value here in these companies. If you can look past the current president and kind of see a future past that, I think that these companies are going to be very strong. I think that we're probably going to see a flip to the Democrats taking the presidency just realistically in the next election. I think it's more likely. That's all obviously speculation, but if that does happen, I do think that we would get new negotiated terms, and I think that a lot of these companies would do better and have less tariffs. Overall, I will say that I am very bullish on these companies, although I have not gotten another position in any. I think Enbridge would be one of my top ones. I think they're very high quality. We can go back here, though. One thing to kind of discuss that I think is a little bit concerning is that the debt is actually higher than the market cap. This is obviously also because there is major investment in terms of the energy infrastructure. These pipelines are not cheap. They're expensive to repair. So over time, they have been repaying a lot of their debt, but definitely these interest rates are also not helping this company. Just something I thought I'd bring up. That's always something you want to look at is the debt and equity kind of weighting. And in this case, the debt is actually higher weighted. So that's not something I usually enjoy, and that's another reason I'm not a super fan of this industry and just the utilities industry, because there is a lot of debt financing. But I think that it's still manageable for Enbridge, and I think that Enbridge is a very monopolistic business. I think that they can make a lot of money with their pipeline, and I think that the future is very bright for Enbridge overall. But I definitely think that there is potentially some better investments, but I could be wrong. And if you think that natural gas prices are going to increase, you think that energy demand is going to increase, which I think is very likely, this could be a very good bet. Once again, not financial advice, not a financial advisor. If you guys liked the video, please leave a like. Please hit the subscribe button. We're over 500 subscribers, which has been awesome. I really appreciate everyone. If it's your first time watching the channel or you've been watching the channel, thank you for coming here. Really appreciate you stopping by. And I hope I was able to give you something additional if you were thinking about, potentially looking at this stock. Have a great rest of your day. Bye.